The Fed did as expected, but what they said. Hey, this is Dave with the Bolduc Realty Group, powered by eXp. Welcome to my weekly real estate market update. It's Friday, September 22nd. I hope you got some indoor plans this weekend because it looks like it might be a washout. Hopefully we're wrong there. Into the Connecticut key market stats. Active on the market, 4,447 today. It's down about 10 from last week. We got about 300 new listings over the last 24 hours, pretty consistent. And as I've said before, about 3,900 closings in August, which was up from 3,400 in July, the month before. Using that August closing number, we got about 1.2 months of inventory on the shelf. Still a very low inventory situation, seller's market. Some key dates here. The Fed did what was expected, but they said more than what was expected. The consensus going into FOMC was that the Fed was going to keep Fed funds rate the same. There's an expectation that there would be an increase, but it's not going to be in September. That's what the Fed did. Where it gets a little dicey is the Fed funds rate forecast. The Fed has repeatedly stated that they expect to keep the Fed funds rate at a high rate for an extended period of time. That forecast put a little bit more credence in it, shows that, they are going to do that. It was a little bit of a surprise for some reason for the markets. They didn't like that. Stocks went down, bonds went down, mortgage-backed securities went down. Mortgage rates took their cues from the bonds and the mortgage-backed securities, and they went up near to 23-year highs at about 7.5%. At this point, I could pull out the chart that I show all the time, saying, hey, if you look over the last 50 years, 7.5 is not bad. It got up to 18. It doesn't take the pain away, so it's not worth it. You guys, In my opinion, the market is still expecting a soft landing and a return to easy money policies. It's looking less and less likely that's going to happen. People are tossing around the R word. Maybe we are in a recession. If not, we probably will be in one soon. The point I need to make here is if we do get to the point of having a recession, recessions do not mean housing market collapse. I'm going to say that again. Recessions do not mean housing market collapse. Recency bias is a tendency to overemphasize recent experiences or the most recent information you have when trying to predict the future. Why am I telling you that? Well, I'm telling you that to tell you this. Anyone in their mid-30s or older, which is a lot of people that are out there buying houses right now, they probably remember the 2008 financial crisis and the associated housing collapse and recession. Unfortunately, many forget that the recession and the housing collapse was caused by the financial crisis. More specifically, the irresponsible lending practices by banks. Those borderline criminal, in my opinion, practices resulted in a lot of mortgages that were never going to be repaid. That resulted in a lot of mortgage-backed securities that were basically worthless, and that caused the collapse of a lot of banks. As the housing market collapsed, the economy came along for the ride, and the result was a pretty rough recession. The key here is the financial collapse caused the housing market collapse and the recession. Recessions do not equal a housing market collapse. The pain experienced in that 2008 recession was real, and it's ingrained in people's memories. Recency bias is driving them to assume that since the last time they had a massive recession, there was a housing collapse related to it, that it's going to happen again if we have another recession. Let's look at a chart that shows house prices during recessions, last 30, 40 years. All right, let's take a look at that right now. As you can see, there's one that just really stands out. And I've used this chart before. There's one that really stands out, and that's the 2008 timeframe. We had almost 20% drop in housing prices. But the vast majority of the other recession periods, you can see housing prices actually went up. So the point I want to make here is recessions do not equal a housing market collapse. The other data that we're looking at all shows that the housing market is fairly consistent, and the reason prices are going up is because of relatively high demand relative to the supply that's out there. Going on to the primary mortgage market survey, average rates have moved up. This report averages rates from Thursday to the following Wednesday, so it doesn't really reflect the jump that we saw after the FOMC statement. Mortgage rates are in the mid 7% range right now. The confirmation from the Fed of their intention to keep rates high for an extended period of time as they battle inflation had a negative impact on the stock market, the bond market, and mortgage-backed securities. The last two, especially mortgage-backed securities, drive mortgage rates. As mortgage rates remain high, demand for housing remains artificially low. The concurrent shortage of inventory, which interestingly is also partially caused by the high interest rates, has prevented the market from flipping to a buyer's market. Should mortgage rates come back down, that pent-up demand is going to be released around the same time that rate-locked sellers start listing their houses. Something to think about there. I don't have a crystal ball, so I can't tell you exactly what will happen. The data indicates the current housing market dynamic will continue for some time. There are some bright spots in new construction and renovation of houses that are in poor condition. On the other side, the foreclosure rates are still below the 2019 numbers, so I don't really see a significant source of inventory there. At this point, the real estate market in Connecticut will continue to be a seller's market with demand that outstrips the extreme low inventory that we have. If you're ready to sell, now's a great time. Give me a call to get started. If you're ready to buy, you need an agent who knows how to put together strong offers and get them accepted. Call me so I can show you how I do that. Hopefully there's some value in this for you. Please click the like, subscribe, ring the notification bell. Comments are always appreciated. Have a great weekend.